Pavel Molchanov, an energy analyst, at Raymond James Associates. He rates the Chevron stock a strong buy, and he's joining us from Charlotte, North Carolina right now to talk more about it. So, Pavel, really the refining, as we all know, was the weak spot in Chevron for the quarter. It came in, though, worse than a lot of folks had expected. What happened here?
Well, refining is a brutal business right now, whether you look at domestic or international. And of course, Chevron has quite a bit on the West Coast of the United States. I think West Coast margins have been especially under pressure. Of course, we've all seen what's happened to the California economy. That's hit demand, perhaps more so than some of the other regions in the U.S. And then in Asia, where Chevron has a fair amount of refining as well, things are doing better, but margins are still low. Crude differentials are narrow. And they've put a loss in both of those areas.
Pavel, do you think that the company might sell or close some of its smaller, less efficient refineries in places like Hawaii or in Canada as part of the refining restructuring?
Well, I think selling refineries right now would be exceedingly tough. Right now, selling a refinery would almost certainly be impossible, except at multiples that are just absurdly low, really pennies on the dollar. I think more likely would be mothballing some plants. We've seen Valero do that in Delaware. We've seen Shell do that in Quebec. Certainly, it's a possibility for some of Chevron's West Coast assets.
And Pavel, at this point, the CEO, John Watson, as you mentioned, at least tried to suggest, they're slashing some payrolls, and right now they're focusing on oil and natural gas wells that can deliver much higher returns.
Well, absolutely. And the upstream or E&P business actually did very well this quarter. They did almost 10% better in terms of upstream earnings than we expected. Had it not been for really the meltdown in refining profitability, they actually would have beat estimates this quarter.
And we said, at least in our story here on the Bloomberg terminal, Chevron's refineries and filling stations losing $278,000 an hour. That's a staggering amount of money.
Yeah, refining, as I said, it's a brutal business worldwide, whether you look at domestic properties here. Europe is bad. Asia is just marginally better. You know, there is systematic overcapacity in the global refining market. Chevron, it should be pointed out, has less exposure to refining on a relative basis than just about any of the big super majors, but certainly it's not immune from the problems of the industry.
So, Pavel, why is still a strong buy on Chevron then? Because even if, as you say, it does have a relatively low refining mix versus its E&P business, if the losses continue like this, it's still going to be a problem, isn't it?
Well, refining certainly doesn't help anybody right now, but I think there are three reasons why Chevron, in my view, is one of the best positioned majors. Number one, it's resource replacement, and we saw 2009 numbers today, which were very good for Chevron. I mean, they're really some of the best resource replacement rates of any of the super majors. They were at 112% for 2009. Second reason is the fact that their refining business is smaller relative to the size of the company than that of many of their peers. And third point, I would just underscore, Chevron has less exposure to North American natural gas than many of its peers. And of course, the advantage there is natural gas prices in North America are very problematic right now. In many ways, what Chevron is doing in Australia with LNG, elsewhere in the world, is much more profitable than North American gas right now. And I think Chevron's strategy is on the right track.
Pavel, I have to ask you also about Exxon, because the company's coming out with earnings on Monday. Given what we heard from Chevron today, Exxon, which is bigger in every way, but also has a bigger refining business, what are we going to hear from them?
I suspect the basic themes will be similar. The upstream business is doing well. Refining certainly is tough everywhere. Again, Exxon, being the world's biggest refiner, is certainly not immune from the problems of the industry. I think Exxon went in a slightly different direction than Chevron through their XTO acquisition. They actually wanted to increase their exposure to North American gas, which may end up being profitable deal in the very long run, 10 to 20 years. But certainly for the foreseeable future, North American natural gas is not going to add a whole lot to profitability.